Welcome to The Explainer. Today, we are diving headfirst into one of the biggest economic questions facing Japan right now. For decades, they've had these rock-bottom interest rates, but is it finally time for a major shift?
All right, so here's how we're going to tackle this. First, we'll set the scene at Japan's economic crossroads. Then, we'll get into the big fight over inflation, followed by the dilemma of the weak yen. After that, we'll ask a pretty deep question. What does normal even look like for Japan anymore? And finally, we'll get to the judge's verdict.
Okay, first up, let's really set the stage here and figure out why this whole debate is kicking off right now, in the spring of 2026. So, what we're looking at is, honestly, a historic choice. For the first time in a generation, Japan is staring down this huge decision about where its economy goes from here. And this isn't just some technical tweak for economists to argue about. No, this is something that could really affect everyone. See, for years and years, the Bank of Japan has had this, well, pretty unusual policy of super low, we're talking near zero, sometimes even negative interest rates. The whole point was to fight off deflation. But things are changing. Now prices are actually rising, and the yen is getting weaker. And all of that is creating this intense pressure to finally do something different.
All right, let's get right into the thick of it. The first major battleground in this whole debate is all about inflation. But it's not just that inflation exists. It's about what kind of inflation it is. And is it the kind of problem you can or should fix with higher interest rates? And on this, the two sides are just worlds apart. On one hand, you've got the Act Now camp. They're saying, look, this inflation is the real deal. It's being driven by people earning more money, and it's starting to stick. So their answer? We have to act now, get ahead of it. But then you have the wait and see side. They're like, hold on. This isn't homegrown inflation. This is just cost push. It's coming from outside, from expensive imports and energy. They're terrified that if you raise rates now, you'll just crush the economy right when it's starting to get back on its feet. And this quote right here, it perfectly captures the absolute core fear of the wait-and-see side. Their biggest worry is that if they move too soon, they'll turn this bad inflation into something way worse, bad deflation. They're afraid of crushing people's ability to spend and sending Japan right back into that deflationary spiral they spent decades trying to escape.
So what's the Act Now camp looking at? What's their green light? Well, they believe the signs are already flashing. For one, core inflation, that's when you take out the crazy swings in food and energy prices. It's holding steady right around that magic 2% number. Plus, they're seeing wage hikes, real ones, for a few years running now. And maybe most importantly, companies are finally starting to pass on their higher costs to customers, and people are paying. That old deflationary mindset seems to be breaking.
Now the wait and see side. Well, they have a much stricter checklist. They're not convinced yet. They want to see real wages. That means your paycheck is growing faster than prices are. And not just for a month or two, but consistently. They need to see that wage growth spreading out from the giant corporations to all the small and medium-sized businesses, where most people actually work. And they want to see this whole thing play out for a few years before they'll even begin to think the recovery is solid enough to mess with.
Okay, moving on to the next big point of conflict. This one hits a bit closer to home for, well, pretty much everyone in Japan. We're talking about the weak yen and what it means for the price of everything you buy from overseas.
So this really boils down to a huge question. Is raising interest rates a surgical tool, or is it a sledgehammer? The pro-hike side says it's a tool. They think a rate hike will close the gap with the US, which should boost the yen's value. That means cheaper imports and some real relief for families. But the anti-hike side sees it as a massive, reckless gamble. They say, hey, the effect on the yen is a total question mark, but the damage here at home? Oh, that's certain. They believe it's absolutely the wrong tool for this job. And this line just says it all for the anti-hike camp. The cost to the domestic economy is certain, while the benefit to the yen is uncertain. I mean, think about that. They see a guaranteed hit to their own economy for only a chance at helping the currency. For them, that math just doesn't add up. It's a bad bet. This next battleground is, you could say, a little more philosophical. It's about this word, normal. After decades of doing things so differently, what does a normal economy even look like for Japan anymore? So the pro-hike side argues that these years and years of zero-interest policy have really messed with the markets. They say it's time to normalize, to get things back to a state where markets can function healthily on their own. But the other side pushes back hard on this. They say, whoa, not so fast. Japan is different. They warn about just grabbing the standard Western playbook and trying to apply it here is incredibly dangerous, especially when you look at Japan's own history with this stuff.
And that history is, well, it's pretty sobering. You can see here, Japan has tried this before. Back in the late 90s, they tightened policy, and the economy took a nosedive. They tried again in the mid-2000s, and boom, stagnation followed. So the wait-and-see camp is constantly pointing to these examples, basically screaming, see, this is what happens when we jump the gun.
Okay, so we've heard all the arguments, powerful points on both sides. The big question is, how did the judge rule? What was the final verdict?
So, just to quickly recap, we've got these three huge battlegrounds: the fight over what kind of inflation this is, the gamble on the yen, and this really deep question about what normal even means. A lot to weigh. And the winner is the affirmative side. That's right, the judge sided with the argument to raise interest rates. But why? What was the reasoning? Well, it really came down to a few things. The judge felt the pro-hike side had a clearer, more consistent argument for taking preventative action. They made a stronger case for managing risks you can't see yet. And the other side? Their checklist for when to act was seen as, well, almost too strict. So strict, in fact, that you might never act at all, and then you risk being way too late. And this quote from the judge really gets to the heart of it. It wasn't about finding a perfectly certain answer, because one doesn't exist. It was about which argument was more persuasive for dealing with an uncertain future. And in the end, the idea of proactive risk management, of acting early to head off a bigger problem down the road, that's what won. So we've laid out the best arguments on both sides of this incredibly tricky issue. And as you can see, there are just no easy answers here. It's a choice between two huge risks: act too soon and maybe kill the recovery, or act too late and let inflation run wild. So now that you've heard the debate, we leave you with one final question. What would you decide?